Welcome to Cash Talk, the podcast where we delve into the depths of finance, business, and life itself. I'm your host, John Cachia, a multi-award-winning wealth advisor with a passion for empowering ambitious Australians to confidently achieve financial freedom. Hey everyone, before we get started, this is a quick reminder that everything in this podcast is of a general nature and nothing has been tailored to your personal circumstances. So please seek personal financial advice before acting on this information. And welcome back to Cash Talk. And today I'm once again joined by Anthony Caligari. How are you, mate?
Good, thanks. Good to be here.
That's it, mate. That's it. And the world of finance seems to have settled down a little bit from an interest rates perspective, but there's still a lot of decision making that people are making, especially in regards to property. And so today we want to kind of delve into around, do I buy a property? You know, do I rentvest? What's the scenario? Because one of the things we're finding at the moment is that a lot of people say want to kind of increase their, you know, maybe the size of their home or kind of upgrade their home, but sometimes it's not really worth it. And there's other considerations we need to make. Now, Ant, what's your view on kind of purchasing at the moment when we're talking about maybe upgrading a home or buying their first home? Yeah, what are the considerations to be making?
Yeah, I think it's a little bit different when you're buying your first home versus trying to get that upgraded home. Usually the first time people are looking for something a little bit more affordable than when they want to upgrade their home. Usually when it comes to that upgrading their home and taking it to their sort of their dream home or that step up, that's where prices start to get a bit more expensive, and there's a few different sort of things to take into consideration, like rentvesting or do we buy that home? But yeah, I think at the moment people are sort of starting to get back into the market and starting to look to buy. I think it's been a bit more active now because there are talks of future rate cuts and the market has sort of, I would say, settled a little bit. So I think things are going to start picking up, and I imagine when rates start to come down, the demand for properties are going to increase, and it's going to be a bit more active out there.
So it's interesting because you talked about it being slightly different, and I think it really comes down to like affordability, like you spoke about, around like people's cash flows. But we've got a few things that is happening when this happens. Like what I mean by that is like when we're looking to say upgrade the home, or we're looking to buy the home, based on cash flows, if they go and do that, their cash flow is going to be under really stress.
Yeah.
And so rentvesting usually becomes a good idea because, one, you've got a property that you've bought, say, as an investment property that you're renting off, which is someone else is helping you to buy that. You get all the tax considerations with that. But also the property that you're in usually is much cheaper in today's market to rent than it is to buy, because when you think about like the costs, when you own a home, you've obviously got all of the interest on that mortgage, but you've got, you know, the rates, the this, the that, you know, the taxes, you know, so the council rates and water and all of that stuff. But when you're renting, you have none of those costs. And usually properties like, and I'm saying if I threw a blanket over all of them and everyone's different, they're kind of between 2.5% to 3% in regards to rental return, yeah, for the investor. So you're renting for 2.5 to 3 times to a landlord, whereas in reality you're paying 6.5%, say, on a mortgage. Yeah. So cash flow is one, but I think it's also very important to know that when we're talking about these options, we're both still having the client with property. Like it's either as an investment or as their own.
Yeah.
And we love property for the sake that, especially when we want to do accelerated investment strategies, both with shares or in property, we've got the ability to leverage. And because if you don't do it, if you're not buying a property, you don't have that ability to gear, that ability to leverage. So for me, people say, oh, well, I'll just rent and I won't. Like, I'd rather you buy, not rent forever. And I think that's you know, some people have said to me, oh, yeah, John, you know, I'll rent and then I'll just buy stocks. You're just not going to have that leverage into stocks that you've got. So you need the combination of property and stocks to be really able to kind of fast track your finances. So it's understanding how the property sits and what's the purpose of it. I think that people need to consider, not just the lifestyle choice there.
Yeah, correct. And I think, like you said, with costs, like what I tend to see often is for someone to buy that property, they want to buy like the loan repayments on that. Let's say, for example, they're 7 grand a month, but to rent that same property, they're paying. I don't know. Let's say they're paying 4 grand a month to rent that same property. So there's about a $3,000 difference there, but if you just break down the numbers and have a look at the, and then people might say, oh yeah, but if you're renting, you're paying, it's a common one, you're paying the mortgage for someone else. But if you had a look and you looked at the numbers, and if you were to buy that same property and just the interest payments alone, not even taking into consideration the principal, and if you compare the interest repayments versus what you're paying in rent, often the interest repayments are still more than what you're paying in rent. Plus, like you mentioned, all the additional cost of rates and those additional things that come into play as well. So often for going to that next level and upgrading your home, sometimes it does work out much more easier with cash flow to be able to rent, and then you rent your existing property out, because like you said, we want to make sure we do have a property at least, because if you're selling everything completely and then just going to rent, you're out of the market. If the market continues to grow and you try to buy back in a few years time, it's probably going to be much harder for you then. So there's a lot of things to take into consideration. Cash flow is a big one, but yeah, just even having a look at the interest repayments versus rent, the difference there, and other things as well to take into consideration, like even maintenance cost. If something goes wrong, at least you don't need to worry about that getting fixed. Like that's something that your landlord will worry about.
And I think this is becoming more of a discussion for the simple fact that people are still wanting that lifestyle. They still want that nicer home, maybe with the next to a river or near a beach or whatever it's going to be. They want that lifestyle, but they don't want to spend $2.5-3 million in a lump sum. And when you run those numbers based on the after tax expenses, because remember you're paying that property off in after tax in income. Sorry. It's a big investment to make.
Oh, for
yeah,
sure.
in something that's not producing you an income.
And not only that, just even the deposit you got to use on something like that, it's huge. Plus the stamp duty cost, especially in Victoria, where we get slugged with stamp duty. Just to even get into the property, not even taking into consideration the repayment, just to get in the actual property, you got to like no, say use a 10% deposit and stamp duty. You're looking at a bucket load of cash just to get into that.
That you're tying up in one asset.
Correct,
you know.
correct. And then you're getting slugged with the repayments every month too. It's hard.
So I know you're working with a couple of clients in regards to this at the moment, and some have explored obviously going down this path of rentvesting. And the reason why is it's obviously not the most common. The most common is someone buys a home, pays it off, and they do investments outside. They borrow against that property to then debt recycle or leverage for other stuff. Yeah, that's the normal way. But there are clients now that we're working with to say, well, the upgrade of the lifestyle is going to be a detrimental position for you, financially speaking. What are some of the things that they're speaking to you that maybe they're a little bit hesitant about going down that path of rentvesting?
I think people, the security of owning your own home is always the number one thing. Like just knowing that you're not going to get kicked out of your home and that's yours. You can do what you want to that home. I think that is the biggest one that makes people want to buy. But as people start to be a bit more open-minded and look into it, they start to realize that the numbers just stack up most of the time to rentvest. And I think the other thing is why people want to get into those areas too. It's usually what it comes down to is education for the kids. They want to be in the zone for certain schools and things like that.
And lifestyle upgrades.
Yeah.
And lifestyle upgrades. So the hesitation is around the security of like, hey, listen, someone can kick me out. But it's interesting because a lot of states around Australia have really kind of made it very hard for people to get just kicked out. And I know your partner, she's in the game, and she's in this exact space of in the real estate game. Are you finding from her that landlords, it's like they don't want to kick out their tenants?
And the other, not only that, it's very hard to kick tenants out. Like the law is more on the tenant side than the landlord side in terms of kicking them out. So yeah, I think in terms of that, the security is pretty high for tenants to be able to stay in there, and especially people looking to buy in sort of those higher end areas where people have probably owned these properties for a while and they're able to withstand them. Some of them probably don't have any mortgages on there, because usually what happens is for people to kick people out of the investment property, it's mainly because what we've experienced, interest rates go up and the property is no longer affordable for them to hold.
A deceased estate, they want to liquidate that property. Yeah, they're not like just
Yeah, it's not like, oh, we want to kick this person out because we don't like them. Like, and most of the time, if you're looking after the house, landlords want to keep good tenants in there. So if you're
because they want that consistent income.
Correct.
Like on the flip side, if you're rent investing and you've say got a property that you're investing in, you want that tenant to be long term, pay on time, look after the house. Like, so yeah, it's interesting that like security and the hardness of getting out the tenants, because it's like logically speaking, it's not a real logical scenario. It's more of a fear that maybe not even be there.
It's more of an emotional decision, I think, rather than logical, because logic points one way and then the emotion takes you to the other direction.
So, Anth, you've purchased the house. I've purchased the house, yeah, and we didn't rentvest, yeah. What was your considerations about buying a home, not rentvesting, and have you considered it? Because obviously this is your first time that you did. Like maybe the next time, like if you were going to upgrade, is this something that you'd consider for yourself?
Look, potentially. I know this first home I bought, I didn't really consider rent vesting, because at the time I had my first home buyer concessions, and it was much easier for me to get into that first property.
So let's hold on that. But that is interesting, because obviously you're taking it from a frame of mind around like you've added up all of those pros, and those were things like first home buyer concessions, first home buyer grants. These are very important factors. So you're taking into consideration like a cost benefit analysis. You're going all the pros, and it was like not an option, but the pros were you just buy this house.
Yeah, the difference between loan repayments versus if we were to rent in the same area, they weren't too much different.
And you probably wanted to get in the market, I would imagine, to allow for that gearing.
Correct. I wanted to be able to sort of have a property, like at least one property, and then if down the track rent vesting potentially, like I haven't ruled that out. It's not something that I've thought about. I'm not really in a rush to move houses or anything like that. But if I was to say go into an area where property prices were a lot more, it would be something that I would consider.
And so, if you like, it obviously comes for you and for me is if you're looking to kind of really upgrade that lifestyle, isn't it? Because if you stayed in that house where you paid down your debt, you then leverage off that property. Like, unless you don't get enough leverage from that property and you really want to accelerate it, that's when you need to get like multiple. Yeah. Like, so let's say your next property or your next investments, are you of the same frame of mind of me of like, I just only get that next investment because I need to leverage more? Because let's say a property's worth $1 million. Even if you paid it off, 800 grand is your maximum leverage, 80% of the value before getting any lender's mortgage insurance. It's only unless you wanted to get like more than 800 grand that you need the additional property. Because it's bad from an income perspective. We just talked about, rents being 2.5 to 3.5, 3.5% as a general rule. And then, all the costs that's associated. So it's not a real income generator.
Yeah, I don't think you don't buy an investment property to make an income. I think the logic, like if you're buying an investment property, you want that for the capital growth, because the income from an investment property, when you take into consideration all the cost, it's not very favorable, especially with all sort of the maintenance issues, land tax rates, interest rates being at the level they are. Yeah, so going back to what you're saying, if I'm buying an investment property, it would be for that capital growth, to get that leverage, to be able to use that money to invest elsewhere.
And what's very interesting is for everyone is that capital growth is not taxed until you sell it. So being able to leverage and use that capital growth to then invest further, very, very tax effective way to grow wealth. So it's when you generate income that you get taxed on it. So you can see the fascination around having property in Australia, because you can use it, leverage, and invest. The magic happens is when the ability to use both property and stocks and other assets to then generate wealth moving forward. And even for me, I have no intention of having a property empire at this stage. For me, it's around having enough leverage, which is a comfortable level to jump on opportunities when they arise, being able for me to rebalance my overall portfolio within my risk tolerance levels and also in line with my goals and aspirations for me and my family. And obviously we work this for me and my wife, because for people that are jumping on for the first time, Anthony's my financial advisor for me and my wife. That leverage piece is just so important. And so that when we go back to rent investing or buying a house, if you don't have a property, buying is my number one.
Yeah.
Buy. Get in the market, get the capital growth, pay off the house, let's get some equity in that property. Let time be your best friend, try and do it as early as you can.
Yeah. No, I agree.
Yeah. And it's only until you want to do that lifestyle upgrade. Yeah. Or you want to try and convert that house into an investment so that there's some tax deductibility around that. But that's secondary. I think the first home, trying to get into that house. Now, there might be some people that say, oh, John, do you then go buy an investment property while I'm living with mum and dad? Sure. The best arrangement is living with mum and dad, yeah? But I do understand the idea of buying, using the concessions, first home buyer, stuff like that in Australia, and then getting in there. Because you don't want to miss out on the opportunity to get into a property, yeah? And it's much harder to get into a property from your first home without using the concessions than it is with using the concessions.
Yeah. Like realistically, if you run the numbers, one of the easier ways to get into the property is if you were to buy property as your first home, you get things like
you can use the first home buyer super scheme.
Yeah.
You can use first home buyer
yeah,
grant,
like first, and then you got the
concession on stamp
yeah,
duties.
like you can pretty much buy property with the 5% deposit. If you're buying, then depending on your price range, because there are concessions, you can get, let's say in Victoria, you're buying something for under 600,000, which look, it's not quite easy to find a property like that. But you could literally do that with the 5% deposit. You pay no stamp duty because under 600,000. You live in there for a year, and then okay, let's say you go back to go live with your parents and rent that out, and then wait a few more years till you're ready, and then you move back in there. That may be one of the ways you do that.
So, Anthony, you didn't do it yourself, but you obviously have had clients do this, and even friends where they buy an investment property first, but they're renting. So they've gone rent vesting straight away. What's your thoughts about that? Like, I'm saying, like, obviously every situation works, but let's say you've just got a 25-year-old coming in or a 35-year-old coming in and say, Anth, which is the best way? Obviously the numbers, but what's your thoughts around that?
Look, so the good thing about that we haven't really touched on too much about rent vesting is the tax deductions you get on that investment property. Like all of that interest is now tax deductible, which is a pretty big benefit.
Huge leg up. Yeah.
And that's probably the biggest advantage. Well, there's the savings on rent versus the loan repayments, but then you've also got the interest deductions that you get from the loan, which is also a massive one. But if the numbers work and you have it and we run the numbers, say, okay, what would it cost me to buy in this area versus what will it cost me to rent in this area, and then if I wanted to buy an investment property elsewhere, what would that look like? As long as it works with cash flow and you're not stretching yourself too much, I quite like the idea of renting straight off the bat, renting and then buying an investment property. Because like you said, you've got that property that you can leverage off in the future.
So the biggest thing is getting the property as early as possible.
I think so because look, earlier in life is probably when you've got the least expenses. Like let's say if you're living with parents still, that's when you're probably the bare minimum expenses. That's when you got the opportunity to
even
save
before kids.
Yeah, and
even before kids. That first bit, like before kids, even like you'd probably argue that before they hit school, yeah, it's relatively the lowest point in regards to your expenditure.
Yeah. Before kids come, income expenses are going to be the lowest. Borrowing capacity is going to be better too because that's not taken into consideration. And then you get that property, start paying down the mortgage. So then by the time you've got kids and you've got those childcare expenses and you're probably not working as much as you were working before, that's okay because that loan now is a bit less than what you started with, and repayments are going to be a little bit less to compensate for that lower income and the increase in expenses.
So, Anth, I just want to brush on a final topic. And this one's around people often come to me and be like, John, we've got a property, we've got our plan in place, we're doing what we need to do. I want to accelerate this thing, I want to buy another property. I know you're laughing because you probably get that every day, yeah?
Yeah.
What's your... Like, obviously, Australians have a fascination about just having a massive property portfolio. When do you give the trigger that it's okay for you to do it? When do you tell a client that, yep, let's go out and do it? And what are some of the people that you might need to say, yes, but not now?
Yeah, so there's a few things that I consider. Diversification is one. Making sure if they're property heavy and they don't have any other investments, I want to make sure we're looking at other things because yeah, it's great to have property, but if we've got only property and we're not investing in the stock market, that's something that I don't like to do. I want to make sure that not all our eggs are in one basket.
And that's because we can't sell a bathroom if we need to liquidate. So we need some liquidity there. And also there's characteristics of the stock market that are better than the property market. And there's characteristics of the property market that is better than the stock market. Yeah?
Yeah.
Okay, cool.
The next one is cash flow. Make sure there's good cash flow. Like we stress test and make sure, regardless if interest rates go up, there is a buffer there that if interest rates go up, you're still going to be able to pay both your mortgages and you not need to stress too much about money. Making sure that if rent was stopped for a little bit, you're still able to afford that.
And when we're talking about stress testing, guys, like we usually do like a 3% buffer. Yeah, so if the rates say 5%, we're doing like 8% on lending buffers. If it's long-term cash flows, inflation at 2.5%, we're doing them at 7%. Investment properties, we're doing it 7.5%. So you can see that's like 5% above inflation. Yeah, so we're putting measures in place. And people might say that's crazy, it's conservative, but it makes sure that you don't sell that property in time of stress. It's very important. Yeah, we want to hold the property for as long as possible. Yeah, and then cash buffers.
Yeah, that was my last one. Cash buffers, making sure the money is there. Like we don't want to utilize all someone's money that's in their bank account to be able to buy this property. We want them to be able to buy the property and then make sure there's still a healthy amount of cash sitting around in case something happens, in case you were off work for a little bit or something comes up that's unexpected.
Renters
maintenance
can't pay
cost.
Yeah.
So
how much would that be, Anthony? Is there any do you use like a guide or what's the go?
look, it's different for everyone, but what I'd like to say, like blanket rule, I would say at least 3 months worth of living expenses to make sure that is sitting there. So if something does go wrong,
and that's including like renters not paying.
Yeah, that's just 3 months worth of. Well, I don't even take into consideration the income. Just the expenses, making sure because realistically, if you want to make sure if you are if your income completely stops everywhere, we want to make sure that you can last at least 3 months to cover your expenses.
And that's probably not ideal. Like if someone had 3 months, you're probably still thinking like,
yeah, I'd like to push that a little bit more. And then it also depends on like what people have for backup plans. Like, do you have an income protection policy, things like that? Because some people might have an income protection policy with a 90-day waiting period. So
then that takes out that health risk, but then so you're then mitigating the rental risk.
Yeah.
And the thing is that you'll hear us often talking risk, guys. Like we know that there's people that always talk in returns. This is what the property market made, or this is what this made, or you should do this because I'm making this money. People who talk in returns are amateurs, not professionals. Because when you talk in returns, it's like driving and looking in the revision mirror. Those returns have already happened. Yeah, we talk in risk. Yeah, so you can hear Anthony talking about diversification risk, trying to do that, liquidity risk. He's talking and mitigating all of these risks to ensure that there's the highest probability of you achieving what you need to achieve. Okay, mate. You talk like me now. I think I've created a clone.
Everyone likes to ramble on about the returns they make and when they're making money, but you don't hear about when people are losing money, and that happens a lot. Like. Properties, I think some people think that properties don't lose money, but properties go down in value as well, just as much as the share market. But because properties don't get priced in every day or people don't sell properties in the short term, you don't really see that. But sometimes I hear people say they want to buy property and hold it for 2 years and then try to flip it off. I'm like, there's so much risk involved in that because if that property price goes down, you've still got a mortgage to repay on that. There's a lot of risk involved.
And I think, and this brings me on to a really good point because I was actually thinking about this today on the drive in, okay? And I'm just thinking like, there's this fascination that I keep hearing from people. It's like, oh, I want to go faster. 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 And sometimes we get this from our clients. I'll be honest with you. Like, it's like, we want to be faster. And when they talk faster in their language is around, I want my dreams to happen sooner. But you do that, you go faster. It's like driving in a car. You do 60 kilometers an hour or you do 220 kilometers an hour. That accident, if that happens, is much bigger. You go from having maybe a broken arm and some broken toes to potentially in ICU struggling, life-threatening injuries. And so I studied risk management. That was my major. That's what I fascinated in. Even after university, all my life has been risk. Besides probably behavioral finance, which is another huge one that I'm obsessed with. People want to keep adding risk, but not understanding the trade-off. Yeah, remember, it's high risk, high return. And that's what they say, and then they stop. It's like saying a sentence, but also high potential losses. It's that high potential losses that you need to be concerned about. Because if you can get to the destination slowly and safely, you're creating certainty. And it's what we do is create certainty. Yes, we want all of our clients to get there sooner, but we want them to get there. Yeah, and I think that you need to build your plans. You need to build your finances with making sure you become financially free when and how you want to, and living a fulfilled life along the way.
Yeah, it's funny. It's funny that you said that. I had this conversation a couple of weeks ago with one of my clients because went through the modeling, everything was fantastic, and then they said, "Oh, we've heard about gearing. Like, is that something that we should do?" And I looked through. I stopped my my record, like sharing the screen with them. I said, "One second, guys. Like, we're able to do everything you want to do in life. Go on all the holidays you want to have. Start a family. Be debt free. Retire when you want to retire. Why do we need to take more risk than we need to and risk jeopardizing all that by taking additional risk that we don't need to take?" Like, yeah.
And just put in perspective, do you remember like how quickly they were paying off their debts and stuff?
Like, their debt was getting paid off within like 10 to 12 years, I think.
So like incredible anyway.
Yeah, no, it was a decent sized loan too, and like they were able to do everything they want. And like, yeah, by adding in gearing, you probably would have added, let's say, another $1 million by the time in 30 years' time. But that's sort of irrelevant because if you're able to do everything you want to do, like everything that you want to do, why try take that extra risk for that extra money that you don't really need?
It's only getting you to financial freedom.
Yeah,
And living the fulfilled life. Everything above that is just because you have greed and you want more. Now, don't get me wrong. If your financial freedom number, like I was working with a client yesterday with Mason, the other advisor, and the guy was talking about he wants a passive income of $500,000 when he retires. Now, the guy's worth bucket loads, yeah, but he wants $500,000. To be honest with you, it actually wasn't that hard to get. And all of his investments at the moment, or the majority of his investments, were what we call satellites, okay? They were like mainly startups and little pockets of this, but he had no core structure. And I said to him, mate, you could go gangbusters. You could have a valuation of not 12 mil, you could have a valuation of 25 mil, but you could also have a valuation of 0. Like, how certain do you want to have that $500,000 a year? I want it, John. That's exactly what I want. Okay, cool. Actually, we're going to de-risk everything for you now. He's taking too much risk because of the difference between 0 and 12 mil. You know what I mean? So when we talk about property, love it, understand why you're doing it, understand the purpose of it. And hopefully today's been very, very insightful around people that are considering about doing rent investing. We are all for considering it. It doesn't mean that it's for everyone. It's for some people. Buying a home is still very, very good option for a lot of people. But I think like Anthony talked about, there's a lot of things that you need to consider. You need to run your numbers, you need to have a plan, and you need to stick to it. And you need to stop chasing shiny objects and listening to barbecue advice. And hopefully this podcast helps you to break through some of those. So if you're loving this stuff that we're doing, please subscribe to our YouTube channel. Share this with all your friends and family. We love doing them, and hopefully it empowers you for a greater financial future. Have a good one, and thanks, Anth.
Cheers.